I'm currently holding around 40% cash in my portfolio. Lots of investors would say that's a terrible idea because over the long run, cash gets destroyed by inflation and massively underperforms stocks. But the data actually tells a much more complicated story. Let's start with the obvious point. Cash is a poor long-term investment. Over the last century, cash has returned around 0.3% per year above inflation. That's the long-run real return you might expect from holding cash. Equities? Around 6 to 7% real return. That difference is enormous. From 2009 to 2020, during one of the strongest bull markets in history, $100 became $674 in equities, $403 in 70% equity, 30% cash portfolio, $281 in 50% equity, 50% cash portfolio, and $117 in 100% cash portfolio. That's the cost of cash. Not a small gap, a massive one. So if you just sit in cash, you will fall behind. And the catch-up math is brutal. After a strong bull market, the numbers get very big. Following the 2009-2020 bull market, a 70% equity and 30% cash investor would need roughly a 40% market crash to catch up. A 50% equity, 50% cash investor would need closer to a 58% crash. And a 100% cash investor would need an 83% market crash to catch up, just to break even with someone who stayed fully invested. That means if markets keep rising while you sit in cash, the hurdle just keeps getting higher. This is why holding large amounts of cash without a clear plan is so dangerous. But investing isn't just about returns. It's about getting through the ups and downs and ending up in a better place over time. Here's what the data actually shows. First, drawdowns matter. In the 1973-74 crash, UK equities fell over 60%. A 50% equity, 50% cash portfolio fell around 25%. In 2008, US equities fell 36%. A 50% equity, 50% cash portfolio fell about 17%. And in the 2022-24 inflation shock, cash was roughly flat in real terms, whereas long-term bonds lost over 25% in real terms. Cash didn't just protect you, it beat bonds. So cash reduces drawdowns, and that matters more than most people realize because large losses can take years to recover. Second, there are periods where equities don't outperform, and cash holds up just as well. From 2000 to 2010, $100 in US equities fell to about $91. Cash grew to about $128. Cash held up much better than equities over that period. In the 1970s, something similar happened. $100 in US equities fell to $87. $100 in cash fell to $90. Neither did well, but the gap between them almost disappeared. So the idea that equities always win over a 10-year period isn't true. Third, valuation drives future returns. When valuations are high, future 10-year real returns have historically been low. When valuations are low, returns have been higher. So when expected returns are low, the opportunity cost of holding cash falls. And we'll come back to this when we look at today's markets. Put this together. Cash reduces drawdowns. It can outperform over meaningful periods, and it becomes more attractive when valuations are high. Cash probably won't make you rich, but it can be a positive part of any portfolio. However, the strongest reason to hold cash isn't safety. It's about having the option to act when opportunities come. If you enter a crash with cash and deploy it, you can outperform someone who is fully invested the whole time. Here's what that looks like in practice. Late 2008, markets are in panic. Most investors are trying to get out. But Warren Buffett steps in. He invests $5 billion in Goldman Sachs and $3 billion in General Electric. 10% annual income plus the right to buy shares at a fixed price. These deals made several billion dollars. Why? Because he had cash when no one else did. We won't get those exact deals, but the principle is the same. When markets fall and others are selling, opportunities improve. Cash is what allows you to act. Warren Buffett puts it like this: be fearful when others are greedy, and greedy when others are fearful. Cash is what allows you to actually do that. This is the key distinction. Cash is not there to earn a return, it's there to give you flexibility when opportunities appear. But here's the catch. Cash only works if you're willing to use it when markets fall. Let me show you an argument against holding cash. If you miss just a small number of the best days in the market, your returns collapse. For example, data from US markets over the past 20 years shows missing just a small number of the best days can dramatically reduce long-term returns. So the impact is significant, and the conclusion seems obvious. You should stay fully invested at all times, because if you're in cash, you risk missing the recovery. But there's a problem with this argument. It only tells half the story, because the best days often come close to the worst days. And the full data shows something important. Avoiding the worst days actually improves returns more than missing the best days hurts them. In some datasets, missing both the best and worst days actually improves returns. In other words, avoiding losses sometimes matters more than capturing every gain. So the issue isn't simply being in or out of the market, it's when you're in or out. And that's where behavior comes in. In theory, you would move to cash before markets fall and back into equities when they're cheaper. In reality, most investors do the opposite. They stay invested through the worst days and then move to cash after markets are already down. And then they hesitate to get back in, which means they miss the best days. That's the real trap. Cash isn't the problem, it's using it without a plan. That's why cash only works if you're clear on one thing. You're holding it so you can buy equities when they're cheaper, not avoid the market altogether. So what about today? Short-term rates are around 3.5 to 3.75%, and cash is earning roughly 0.2 to 0.4% real. Now compare that to equities. US equities are trading on roughly 20 to 21 times forward earnings. That's an earnings yield of about 4.8 to 5%. So the equity risk premium over cash is only around 1 to 1.5%. Historically, that's low. And using today's CAPE ratio, the data suggests low real returns from equities over the next 10 years. So in absolute terms, cash isn't especially attractive today. But relative to expensive equities, especially in the US, it's more competitive than usual. And that's why I'm holding around 40% in cash. Not because cash is a great investment, but because expected returns elsewhere, particularly in US equities, aren't that compelling right now. And I want to be able to buy equities when markets fall. So here's the conclusion. Cash is not bad, but it's also not free. If you hold too much for too long, it will hurt your returns. But if you use it well, it can improve outcomes. But using it well means doing something very hard, buying when others are selling. Lots of investors don't fail because they picked the wrong asset. They fail because they panic in crashes or hesitate when opportunities appear. Cash can help with both. It reduces the pressure in downturns, and it gives you the ability to act when prices are lower. So the question isn't, should you hold cash? It's, why are you holding it, and what will you do with it?